Something happened in the silver market that most people completely missed. Not because the information wasn't out there, it was. Not because it happened too fast, it didn't. People missed it because they weren't watching the right thing. And here's what makes that so costly. This same signal, this exact same setup, appeared 3 times in the last 2 years. Each time it showed up, people recognized it along the way with changing hands. They watched from the sidelines, wondering why their portfolios were moving while others seemed to be acquiring and building real wealth. So when silver crossed $90 an ounce for the first time in decades, a very small group of traders sat back in their chairs, without a slow breath and said, there it is, because they had been waiting, specifically patiently and deliberately waiting. Today, I'm going to tell you exactly what they saw. History said, what was next. Stay with me through this entire video, because the part that most people skip over, or near the end, is the part that actually changes how you think about your money. Before we go any deeper into this, I want you to think about something for a second. Think about the last time you heard someone in your circle, a friend, a coworker, a family member, casually mention silver as an investment, not gold. Silver. That silence, total lack of conversation around silver is actually one of the most powerful indicators that something significant is building under the surface. History has a funny way of rewarding the people who pay attention to things that most people are ignoring. Right now, silver is one of the most ignored, most misunderstood, and most potentially explosive assets in the world. Not because some YouTube channel said so, because the data, industrial demand, monetary history, and price order, that convergence doesn't happen often. When it does, it doesn't stay quiet long. Now, if you're new here, welcome to the channel. My name is John, and what we do here is take complex financial and market topics and break them down in a way that actually makes sense for regular people who are trying to protect their wealth, grow their savings, make smarter decisions with their money. If that sounds like something you want more of, hit the like button right now and subscribe to the channel. I put up videos like this regularly, and I don't want you to miss what's coming next, because the follow-up to today's story is going to be even more specific. So hit subscribe, turn on the notifications, and let's get back into it. Let's go back to the beginning. Let's talk about why silver crossing $90 is not just enough. To understand why the price level matters so much, you have to understand what silver actually is. And while that's technically true, it's also like describing the ocean as just a big public park. Silver is simultaneously one of the most industrially critical materials on Earth, one of the oldest forms of money in human civilization. The dual identity, industrial commodity, monetary metal, is what makes it unlike anything else in the market. Gold is mostly held as a store of value. Oil is purely industrial. And silver sits in both worlds. It creates a very unique kind of pressure in the market. Here's what the industrial side looks like right now. Solar panels, electric vehicles, semiconductors, advanced medical equipment, water purification systems. Every single one of these technologies requires silver, and every single one of these sectors is growing at a rate that the world has never seen. The International Energy Agency published data showing that solar installations alone will require hundreds of millions of over the next decade. That's not speculation. That's already in the pipeline. Factories are being built, contracts are being signed, demand is locked in. Here's where it gets really interesting. Silver mine production has essentially been flat for years. We're not finding massive new silver deposits. Existing mines are getting older and harder to extract from. So you have surging demand on one side and constrained supply on the other. Anyone who has ever taken a basic economics class knows where that is. But here's the part that the industrial story alone doesn't explain. It doesn't explain why $90 specifically matters. For that, you need to understand the price history, and more importantly, you need to understand what happened the last 2 times silver got close to this level. The first time, silver flirted with truly extraordinary prices. January of 1980, to be exact. Silver hit nearly $50 an ounce, which in today's dollars that spike was driven by a combination of inflation, monetary instability, and the famous attempt by 2 Texas billionaire brothers, the Hunt brothers, to corner the silver market. The government eventually stepped in, changed the rules, and silver collapsed almost overnight. But the key takeaway isn't the collapse. The key takeaway is what preceded it. In the months before that peak, silver had been quietly building. The macro environment was uncertain, inflation was out of control, and a small group of investors had been accumulating silver for years before anyone else woke up. The second major episode, silver hit almost $50 an ounce again. the setup is arguably more powerful than either of those two previous ones. Because this time, you don't have just one catalyst, you have multiple catalysts all converging simultaneously. You have an inflation story, you have a monetary credibility story, you have an industrial demand story, you have a supply chain system, you have a geopolitical story. Five separate forces all pointing in the same direction at the same time. It's not noise, it's signal. Let's talk about the monetary side for a moment, because some things get philosophically interesting. For the last several decades, the US dollar has been the world's reserve currency. That means countries around the world hold dollars and dollar-denominated assets like US Treasury bonds as their primary savings. But something has been shifting quietly over the last few years. Countries that used to be enthusiastic holders of US Treasuries have been quietly losing holders. Russia, Saudi Arabia, Brazil, and several other major economies have been making moves toward trading with each other in their own currencies, reducing their dependence on the dollar. This trend is called de-dollarization. It's not happening overnight, it's happening. And when the world's reserve currency starts to lose credibility, even slowly, people and institutions start looking for alternatives. Gold has historically been the first alternative to reach for. But silver follows gold. It always has. And the gold to silver ratio, which is a measure of how many ounces of silver takes to buy 1 ounce of gold, has been historically elevated for years now, suggesting that silver is significantly undervalued relative to gold, even at current prices. When that ratio normalizes, silver's price has to do something dramatic to catch up. Let's pause for a second and make sure we're being intellectually honest here. Because anytime someone talks about a precious metal going up, I always alert this conversation. I'm not here to tell you that silver is going to $1,000 and you need to buy as much as you possibly can. That would be irresponsible, frankly, insulting to your intelligence. What I am saying, and what the data supports, is that a confluence of structural forces is creating a foundation for significantly higher silver prices over multi-year time. It's different from predicting a short-term measure. This is a structural thesis based on supply, demand, monetary dynamics, and historical precedent. Those kinds of theses, when they're correct, tend to play out more slowly than people want, more powerfully than most people expect. Let's talk about what happened specifically when silver crossed $90 this time around. The move didn't happen in a vacuum. It happened against the backdrop of continuing uncertainty around the U.S. fiscal policy. The national debt has crossed $36 trillion. Interest payments on that debt are now one of the largest line items. Bigger than what the U.S. spends on defense, bigger than Medicare, bigger than almost anything else. And the country is spending more on interest than on almost any other single expense. It's a warning sign that the fiscal trajectory is unsustainable. Markets are starting to price that in. And one of the ways markets historically price in fiscal stability is by rotating into hard assets. Gold goes first, then silver. And the move in silver, when it comes, tends to be sharper and faster, precisely because silver's market is much smaller. A relatively modest amount of money moving into silver can have an outsized impact on price. The traders who were waiting for the $90 signal weren't just watching the silver chart in isolation. They were watching silver in the context of all of these macro forces. They were watching the dollar index. They were watching commodities. They were watching gold. They were watching the gold to silver ratio. And when silver crossed $90 while all of those in a specific way, it confirmed what they had been building toward for months. It wasn't a trigger to panic buy. It was a confirmation signal that the thesis was intact and playing out on schedule. Let me tell you about a concept that serious market students call the wall of worry. In markets, bull runs, major sustained upward moves in price, almost always climb a wall of worry. That means the price goes up, even as there are constant reasons to be skeptical, constant negative headlines, constant voices saying this can't last, this is too high, it's going to crash. The wall of worry is actually what makes bull markets durable, because as long as there are skeptics, there are still buyers who haven't entered the market. Fuel hasn't run out. Silver has been climbing that wall for the better part of 20 years now. Every time it pulls back, people declare it's over. Every time it surges, people say it's a bubble. Neither of those extremes is right. The trend has been higher, and the fundamental reasons for it have only gotten stronger with time. Here's something that I find genuinely fascinating about the psychology of silver investing. There's a very specific group of people who understand silver deeply, who study its history, who understand its industrial role, its supply and demand data closely, and they tend to be some of the most patient investors you'll ever encounter. They're not the people who push every 10 minutes checking the price. They're the people who bought it $30, watched it fall into didn't pay, fell through the noise, and are now sitting on positions that have tripled. Patience in this market is not just a virtue, it's literally a strategy, because the volatility of silver against a scenario where the financial system comes under serious stress, that physical silver, held in your possession or in a secure private vault, is the only version that actually serves that purpose. The silver ETF is a piece of paper that says you have control on silver. If the financial system comes under serious stress, pieces of paper that say you have a claim on silver are historically not performed as well. On the other hand, if you're trading silver for price appreciation in a functioning market environment, then ETFs offer the quality and convenience that physical silver can't match. The right answer depends on what scenario you're actually preparing for, and I'd encourage you to think clearly about that before you make any decisions, because the answer genuinely matters. Now I'm going to talk about what the next 12 to 36 months could look like in the current I want to be careful here to frame this as a possibility rather than a prediction, because markets are inherently uncertain. Anyone who claims to know exactly what's going to happen is either lying to you or lying to themselves. But if we look at historical analogs, the 1970s, the post-2008 period, even going back further to major monetary transitions of the 19th century, the common pattern is that silver, once it breaks through psychological price levels with general structures, leads to bigger phase of acceleration. Faster, more dramatic, and more sustainable. The public starts paying attention. Media coverage increases. Retail investors enter the market. And the additional demand layered on top of already constrained supply creates a feedback loop that can take prices to levels that seem completely reasonable just a year or two earlier. I'm going to give you a specific number to think about, not as a target or a guarantee. As a historically informed scholar, the gold to silver ratio has averaged roughly 60 to 1 for a long run. Gold, we're sitting at $3,000 an ounce, which it has already achieved, and the ratio normalized back toward that historical average. Silver would be at $50. It's already in the rearview mirror. If the ratio moved toward the tighter levels seen at previous silver peaks, 30 to 1, even 15 to 1, gold at $3,000, silver would be at $100, $200, or beyond. Now again, I'm not promising those numbers. What I'm telling you is that the math of the gold to silver ratio creates a structural argument for significantly higher silver prices that doesn't require any exotic scenario. It just requires the ratio to normalize toward its own historical average. It's a boring, conservative scenario, and even that boring conservative scenario is boring. Something I think is important to address head on is the question of risk. Because having an honest conversation about opportunity has to include an honest conversation about what can go wrong. There are several things that could work against silver in the near term. A sharp economic recession could temporarily reduce industrial demand. If investors panic and sell assets broadly, silver tends to get sold along with everything else, at least initially. A significant strengthening of the US dollar could create gains for dollar-denominated commodities, silver. If central banks manage to bring inflation fully back to the of monetary hedging assets diminishes. These are real risks, and they deserve to be taken seriously. The counter-argument to each of them is that the structural supply deficit doesn't go away in a recession. The dollar's long-term trend is under real pressure for de-dollarization. The soft landing scenario is looking increasingly complicated, given the debt dynamics with its external. Reason to disagree about how this and factor of uncertainty into any decision you make. Here's something I want to leave you with before we wrap up today, because I think it's the most important thing I can say. The biggest mistake most people make in investments like silver isn't buying at the wrong time or selling at the wrong time. The biggest mistake is not understanding what they own and why they own it. If you buy silver because you saw a YouTube video and it's something exciting, you will sell it the first time. 100%. If you don't have the conviction to hold through the volatility. But if you buy silver because you understand the supply and demand dynamics, because you understand the monetary history, because you understand what fits in the context of your overall financial picture and your specific goals, then you can hold through the noise with confidence, because you know where you're going. Understanding is the foundation of conviction. And conviction is what separates the people who actually capture the gains from the gains and never quite catch them. We've covered a lot of ground today. We've talked about why silver costing $90 isn't just a number. It's a signal embedded in a much larger structural story. We talked about the industrial demand side, the monetary history, the supply deficit, the gold to silver ratio, the psychology of silver investors, the risks, and the historical scenarios that give context to what might come next. And through all of it, what we came through is not hype, not fear, not a call to action driven by hope. What I hope came through is clarity, because the silver market right now is not complicated. It's actually quite simple when you strip away the noise. Supply is constrained, demand someone who has been skeptical of the purchase of those thesis for years and you're starting to consider, whatever your situation, I want to hear from you. Drop your thoughts in the comments below. Tell me where you're at, what questions you have, what part of today's story surprised you most. Those comments don't just help me understand they help other people in this community who are asking the same questions. If you got something valuable in today's video, share it with one person in your life who needs to hear this story. One share that you can genuinely change how someone thinks about their financial future. That's not something I take lightly, and I don't want you to either. I'll be back very soon with a follow-up to today's story, and in that video, we're going to get much more specific. We're going to talk about application, specific vehicles that give you exposure to silver, about a time frame that serious traders use. You do not want to miss that one. If you haven't subscribed yet, do it right now. This is John from John HG 1.0.